Imagine a world where a single curved line meant everything. For decades, the swoosh was the ultimate symbol of main character energy. It wasn't just a shoe, it was a golden ticket to the top. From Michael Jordan's gravity-defying leaps to LeBron James's total court dominance, Nike owned the cultural zeitgeist. They positioned themselves as the untouchable tech titan of sportswear. Everyone wanted in. But here's the cold truth. Logos are just expensive masks for corporate reality. If you look at the charts, you'll see a legacy brand that is currently bleeding out. 2024 has been a year of common Nike Ls. While the suits in Oregon were busy optimizing their SNKRS app algorithms and chasing digital ghosts, real runners were actually running. They were running straight into the arms of Hoka and On. The swoosh is no longer a badge of elite performance. It is rapidly becoming a discount bin staple found at your local outlet mall. It's a classic case of a skill issue at the highest level of management. They've been ratioed by the very market they used to control. They thought they were gaslighting us into believing that scarcity equals innovation, but the bubble has finally burst. Let's look past the branding and find the untold story of Nike. Let's talk about the moment Nike decided to cut off its own oxygen. Every empire has a turning point where confidence turns into pure, unadulterated hubris. For Nike, that moment arrived in 2020. Enter John Donahoe. Now, John isn't a shoe guy, he isn't a culture guy, he's a data guy. Coming straight from the executive suites of eBay and ServiceNow, he looked at Nike's balance sheet and saw a glaring inefficiency. Why on earth were they sharing their precious profit margins with wholesalers like Foot Locker or the local mom-and-pop boutiques? In the mind of a Silicon Valley veteran, wholesalers were just middlemen eating into the bottom line. He wanted that 100% control. He wanted the consumer direct acceleration. It sounds like a fancy corporate buzzword, and it is, but the logic was simple. Cut out the partners, force everyone to buy from the Nike app or Nike.com, and keep every single cent for the shareholders. It looked brilliant on a spreadsheet. On paper, it was a move with total main character energy. They were going to own the relationship. They were going to own the data. They were going to be the masters of their own destiny. But spreadsheets don't buy sneakers. People do. And people don't always want to wait for a shipping notification. By 2021, Nike began ghosting the very retailers that built their brand. They slashed their accounts with thousands of independent stores. They told Foot Locker that their share of Nike products was going to drop significantly. It was a classic case of corporate gaslighting. They told the world this was innovation. They told investors that their digital ecosystem was a fortress that no one could breach. But while they were busy playing gatekeeper, they forgot one fundamental rule of retail. If you aren't where the customers are, you don't exist. By leaving the shelves of local malls and specialized running shops, Nike lost its physical heartbeat. They lost the impulse buy. They lost the teenager who walks into a store just to see what looks cool. They replaced human connection with an algorithm that only knows how to push the same 5 silhouettes over and over again. This is where the ratio really starts to hurt. While Nike was busy optimizing its digital funnel, the overhead costs of running a direct-to-consumer business started to bite back. It turns out that shipping millions of individual boxes and processing millions of individual returns is actually quite expensive. Who would have thought? The margins that looked so juicy on John Donahoe's iPad began to shrink under the weight of logistics and digital marketing costs. And because they had nuked their relationships with wholesalers, they had nowhere to dump their excess inventory. When the hype died down and the demand cooled, Nike was left sitting on mountains of unsold sneakers. Their warehouses were bursting at the seams. In the past, they could have just shipped that extra stock to their partners. But they had burned those bridges. This wasn't just a tactical error. It was a common Nike L of epic proportions. The desperation became visible in 2023. Suddenly, the tone changed. After years of acting like they didn't need anyone, Nike had to go back to Foot Locker and Macy's with their tail between their legs. It was an embarrassing pivot. They called it re-engaging with wholesale partners, but the industry knew better. It was a surrender. They realized that the digital fortress was actually a digital prison. They had trapped themselves in a loop of their own making. By cutting off their oxygen, they realized they couldn't breathe in a world where physical presence still matters. They sacrificed decades of brand equity for a short-term boost in digital metrics. It was corporate greed backfiring in real time, and the soul of the brand paid the price. They traded the community for a database, and in the process, they became just another commodity. This is the efficiency paradox. You can optimize every single penny, but if you lose the culture, you've lost the game. Let's talk about the creative bankruptcy of the swoosh. There was a time when Nike was the undisputed architect of the future. They didn't just follow trends. They invented them. They gave us the first waffle iron soles and the first visible air bubbles. They were the crazy ones who believed a shoe could be a piece of high-performance engineering. But if you look at their catalog lately, you won't see the future. You'll see a very expensive, very repetitive trip down memory lane. Nike has caught a severe case of retromania, and it is a terminal addiction. Why spend 5 years and $500 million on research and development for a revolutionary new marathon foam when you can just release the same dunk low in 500 different shades of beige? It is a low-effort, high-margin strategy that has officially reached its expiration date. Nike turned into a colorway factory. They stopped being a footwear company and started acting like a printing press for hype. For the last few years, their entire business model relied on 3 things: the Dunk, the Jordan 1, and the Air Force 1. That is it. That is the whole list. They leaned so hard into the resale market and the scarcity game that they forgot how to actually make a better shoe. They thought that if they kept the supply low and the artificial hype high, the customers would never notice that the tech underneath the leather was 30 years old. It was a massive gaslighting campaign directed at the sneaker community. They told us that a slightly different shade of panda dunks was a cultural event. But the internet is undefeated, and the community finally realized they were being played. The resale prices are crashing, the stock is sitting on shelves, and the hype has left the building. This is the definition of a common Nike L. While Nike was busy playing the floor is lava with their inventory of retro sneakers, the rest of the world moved on. While the data guys in Oregon were staring at spreadsheets of colorway performance, brands like On Running and Hoka were actually doing the work. They were in the lab, testing new foams, experimenting with geometries, and listening to what runners actually wanted. They didn't care about being cool in a nightclub. They cared about being better on the pavement. And guess what? Performance is the ultimate form of cool. When serious runners realized that their Nike Pegasus felt like a brick compared to the cloud-like cushioning of a Hoka or the propulsive energy of an On, they didn't hesitate. They switched. The market share for specialized running footwear has been hemorrhaging away from the swoosh for years. It is a total skill issue. Nike got lazy. They thought their logo was a substitute for innovation. They thought they were too big to be outrun. This is what happens when you replace the shoe guy with the data guy. The legendary designers who understood the soul of the athlete have been replaced by analysts who only understand the soul of a pivot table. These analysts saw that Jordan 1s were selling out, so they ordered more, and more, and more. They flooded the market until the magic was gone. They didn't realize that the value of a Jordan isn't just the leather, it is the story. It is the dream. By treating their icons like commodities to be optimized, they killed the very thing that made them special. They diluted the brand until it became mid. That is the ultimate insult in today's culture. Nike isn't hated, it is just becoming irrelevant to the people who actually set the trends. Look at the Olympics, look at the major marathons. The podiums are no longer a sea of orange Nike boxes. You see New Balance, you see Asics, you see brands that were once considered dad shoes, now taking the lead because they never stopped innovating. They kept their heads down while Nike was busy chasing digital avatars and NFT sneakers. Nike spent millions on a virtual world called Nike Land while their physical products were falling behind the competition. They bet on the metaverse while the real world was running away from them. It is a tragic irony. The company that told us to just do it forgot how to do the one thing they were best at. They stopped being the main character and became the background noise of the industry. The swoosh is still there, but the spark is gone. They are addicted to their own past, and unless they find a way to innovate their way out of this hole, they are going to find themselves permanently stuck in the bargain bin of history. Let's talk about the ultimate corporate white flag. In late 2023, the leadership at Nike HQ did something that sent a shiver down the spine of every creative in the industry. They announced a massive cost-cutting plan aimed at saving $2 billion over the next 3 years. On the surface, the PR team tried to spin this as a strategic realignment for future growth. They used words like efficiency and streamlining and optimization, but let's call it what it actually is. It is a massive skill issue at the executive level. When a company like Nike, a brand built on the infinite potential of human achievement, starts talking about saving pennies, it means they have run out of ideas. It is the classic corporate play. When you can't grow your top-line revenue because your products are mid and your customers are bored, you start cannibalizing your internal resources to keep the shareholders happy for one more fiscal quarter. It is corporate survivalism at its most desperate. The $2 billion plan wasn't just about closing a few underperforming offices, it was a bloodbath. They initiated layoffs that cut deep into the heart of the organization. And here is the truly cynical part. They didn't just fire the accountants and the middle managers, they let go of the very people who understood the streets. They fired the creatives, the product designers, and the cultural connectors who were the bridge between the boardroom and the real world. By doing this, Nike essentially doubled down on a sterile, data-driven future. They are betting that their logo is so powerful and so iconic that it can survive a total lack of soul. They think they can replace human intuition with a set of pivot tables and customer acquisition cost metrics. It is the ultimate efficiency paradox. You can optimize your supply chain until it is a work of art, but if the product at the end of that chain has zero main character energy, no one is going to buy it. You cannot optimize your way to being cool. Cool is a vibe. Cool is a feeling. Cool is something that happens when you take risks. And right now, Nike is too scared to take a risk because every dollar is being scrutinized by a guy with a calculator. This is where the gaslighting gets really intense. While Nike is cutting $2 billion from their budget, they are still spending billions on marketing to tell you that they are the innovators. They want you to believe that the soul of the brand is still intact, but look at the internal culture. Reports are leaking out about a workforce that is demoralized and disconnected. When you fire the people who care about the product and replace the culture with a mandate for efficiency, you lose the magic. The legendary Nike campus in Oregon used to be a place where the shoe guys and the athletes would dream up the impossible. Now it feels like just another corporate office park where people are more worried about their KPIs than their designs. They are sacrificing the next 10 years of brand equity for a short-term boost in the stock price. It is a common Nike L that we have seen in so many other industries. When the accountants take over from the visionaries, the clock starts ticking. Investors aren't stupid. They saw the $2 billion cut and they didn't celebrate it as a sign of strength. They saw it as an admission of weakness. The stock market reacted with a shrug because they know that you can't cut your way to greatness. You can only cut your way to mediocrity. While Nike is busy streamlining, their competitors are investing. They are hiring the talent that Nike let go. They are taking the risks that Nike is too afraid to take. The irony is that the more Nike tries to optimize, the more they become like every other boring commodity brand. They are losing their edge in real time. They have become the very thing they used to mock. They are the establishment. They are the slow, bloated giant trying to stay relevant by cutting off its own limbs. They are betting that the swoosh will protect them from the reality of their own stagnation. Spoiler alert, it won't. In the fast-paced world of fashion and performance, being mid is a death sentence, and $2 billion worth of cuts is just a very expensive way to say that you've lost the lead. They are trying to fix a cultural problem with a financial tool, and it is a ratio that will never balance out. So, what is the final verdict on the house that Phil Knight built? Let's be real. Nike is currently trapped in its mid-era. They aren't going bankrupt tomorrow. They still have billions in the bank and a logo that is recognized in every corner of the globe, but the crown is slipping, and it is slipping fast. For decades, Nike was the protagonist of the sports world. They had that undeniable main character energy. Every kid wanted to be like Mike, and every runner wanted the magic of the swoosh on their feet. But today, that magic feels like a cheap parlor trick that we've seen one too many times. They have traded their identity as an elite performance brand for a spot as a mass-market lifestyle commodity. They wanted to be everywhere, and in doing so, they became just another piece of background noise. The math simply isn't mathing anymore. While the PR team continues to gaslight the public with talk about re-engaging with wholesale partners and returning to their roots, we need to see it for what it truly is. They aren't going back to Foot Locker because they suddenly care about the local sneaker community or the high school athlete. They are doing it because they are desperate. They are doing it because their digital fortress turned out to be a house of cards. The data guys thought they could predict human desire with an algorithm, but they failed to realize that culture is a living, breathing thing that cannot be contained in a spreadsheet. This is a massive ratioed moment for the entire executive suite. They thought they were the smartest people in the room, but the market has issued a very loud and very clear reality check. Look at the landscape of 2026. The sneaker world has moved on. The people who actually set the trends, the ones who decide what is cool before the rest of the world finds out, have already left the building. They are wearing Asics, they are wearing New Balance, they are wearing Salomon. They are looking for authenticity and innovation, two things that Nike has been in short supply of lately. The Swoosh has become the brand for people who don't know what else to buy. It's the safe choice. It's the default choice. And in the world of fashion and performance, being the default choice is the first step toward becoming obsolete. It is the ultimate skill issue. They had all the resources, all the history, and all the money in the world, and they still managed to lose the lead because they got lazy and arrogant. Don't be fooled by the high production value commercials or the celebrity endorsements. Those are just expensive distractions. The ledger of truth shows a company that has lost its soul in the pursuit of efficiency. They fired the dreamers and hired the optimizers, and now they are wondering why nobody is dreaming about their products anymore. They are suffering from a total lack of vision. They are stuck in a loop of their own making, trying to sell us the same stories from 30 years ago because they don't have any new stories to tell. This is what happens when a brand stops being a creator and starts being a curator of its own past. It is a slow, painful decay that no amount of cost-cutting can fix. The lesson here is simple. You can't data your way to greatness. You can't optimize your way to a cultural movement, and you certainly can't gaslight your customers into believing that a lack of innovation is actually a strategy. Nike is no longer the disruptor. They are the ones being disrupted. They are the legacy giant trying to figure out how to run in a world that has already outpaced them. The throne is empty, and the world is waiting for the next brand to step up and show us what the future actually looks like. Nike might find its way back eventually, but it won't be through another round of layoffs or another 300 colorways of the Dunk. It will only happen when they remember that they are a shoe company, not a data company. Until then, they are just another corporate giant trying to stay relevant in a world that has moved on. Stay sharp and stay informed. Remember, knowledge is your only leverage in this game. If you found this video helpful, make sure to like and subscribe to join our community. This was Behind the Logo, and I'll catch you on the flip side.